Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Welcome, everyone. Thanks for joining today's Savant Live webinar. We're excited to discuss our subject today, taxes and philanthropy, how to give strategically. My name is Rob Myers, a financial advisor. I work out of our Cedar Rapids and Iowa City office. I am joined today by Mike Mesch, who is our Director of Tax and Consulting with Savant. I've been doing this for 18 years now, all with Mike a few office doors down, so it's been a great synergy. Mike, why don't you introduce yourself if that's okay?
Thanks, Rob. My name is Mike Mesch. I'm just going into my 26th tax season. Historically worked with businesses and individuals. Really tax efficient planning is our strong point. Today, we're just really excited to talk about how to donate and really fund your charities in a tax efficient manner. So thanks, Rob.
Before this presentation, I looked up what is a philanthropist? What is the definition, right? And it comes from the Greek word philos, which means loving, and anthropos, which means human, right? So it literally means love of humanity, which is awesome. And if we can, help forward that just a little bit with what we do, that's a really cool way to give back for us. So we're excited to share. So our agenda today, right? If you're going to think about giving, we have to assess your financial resources, your priorities. I think why a lot of people are here today is to discuss the giving vehicles, right? And how those can work with your estate plan, how philanthropy can really work with an estate plan. And then at the end, how to personalize what your plan might be, examining your goals, how it fits in with your retirement plan. And then if we have time, we'll jump into some Q&A, and we look forward to answering any questions. If you do have a question, please put those in the Q&A box, okay? And I will add that this recording will be available. If you miss something, if we fly by a topic too quickly, we'll be able to get the recording to you. So assessing your financial resources and priorities, right? Super important. We have to assure that this fits into your financial plan, right? My job as a financial planner is to really assess, is your giving plan, is your idea of giving how you want to give viable, right? With your investments, with your retirement plan. So before we can really design that giving plan, we have to make sure you're in a good spot, how things are going to look for you long-term, short-term. Do you have a high income year where we need to really be aggressive in giving? All topics we're going to dive into in a little bit more detail here, but like, what is your plan? Is it to children? Do you have specific charities already identified, organizations? Do you have a passion? Is it children? Is it animals? Is it, all the various opportunities out there for your giving? So all big picture questions to think about, but priority one is making sure you're in a good spot to give, right? And that's how working with your advisor, your tax advisor, your wealth advisor, super important in that first piece of the puzzle.
So yeah, and I might add that tax management plan, the second piece of this slide, is just as important. You want to give to charity, but how can we maximize tax efficient giving? There's plenty of times where I know, in my younger years where I've given to charity and come time to do my taxes at the end of the year, and I realize there's no tax benefit received. So how can we think strategically to give to charity and realize a tax benefit at the same time?
Yeah, that's right. So like the investment part of this, it's not just, your allocation, your assets, it's the vehicles. It's, do you have taxable accounts, your trust, right? Your joint account. And giving from those vehicles is going to be a lot different than giving from your IRA, which you can do, and we'll get into, right? So the investment plan, being diversified across investments, but also like utilizing all the investment vehicles available to you, right? And again, this is a broken record, but working with your professional that this fits into your plan. And really, how can we make your plan better potentially with this sort of giving, right? And ultimately it flows into estate planning, right, Mike?
That's right. If you have large charitable giving as part of your overall plan, then we're going to want to look at your estate plan and how can we maybe maximize gifts in your final estate, reduce the overall estate tax if you're subject to estate tax, as well as planning to get assets out of your estate while you're still living might be an appropriate approach. We'll talk about some of the ways to do that.
Yeah, excellent. It's like the priorities when giving, like what is your goal? Is it the tax deduction, which is fine? Is it, just seeing your passion, your charity advancing? Priorities when establishing a plan, do you have the sufficient capital to live on for the rest of your life, right? We can't jeopardize 20 years down the road for giving today, right? So we need to work to incorporate this into your plan, really map out cash flow today and cash flow years down the road, right? Will your spouse be taken care of? We have to assure that your loved ones, have means, have the capital available to meet their needs if for some reason something happened to you, right? So there's strategies to take to assure your family is taken care of while still giving, right? Maybe testamentary gifts. Importantly, are you examining the tax efficient portfolio strategies, right? There are ways to improve your portfolio by giving, right? We're going to get into that, giving appreciated assets, right? Donor advised funds, things like that. Really, are you protected from unexpected occurrences later in life? Illness, premature death, right? Life insurance. Are your heirs, your second generations protected to the point you want them to be, And if there's extra left over, there's ways to give that away as well. So all important priorities to examine, to think, like big picture items as you're formulating your giving plan. If you haven't already, like questions to think about. So income sources, pensions, right? Real estate income, business distributions, things like that. Like, are your income sources secure to the point where you're not relying on just your investment assets and you might have the means, the tools to give a lot away today? Or alternatively, if your income sources are somewhat tight today, well, then we look at strategies to give later on, when assets have accumulated. Are your withdrawal rates safe, right? 4%, 5%. We don't want to jeopardize, again, future cash flows, your future security by taking steps today, removing assets from your estate, giving assets away that impact you later in life. And it's a difficult one, can you anticipate care expenses later down the road? Is your family history one of longevity, right? Or one of a particular ailment, generation to generation that you need to plan for, right? Or do you have unneeded assets? Are there assets just accumulating that you have had no need to touch, right? They're working well for you. How can we use those to incorporate into your giving plan? So general rules of thumb as we're doing the broad assessment, making sure giving is something that makes sense, and assuming it does make sense, like how to best do it, like we'll look at your cash flow analysis. We're going to look at the probability of success, right? We want to make sure that your plan is sturdy, has the means to jump into the philanthropy that you wish to do, right? Portfolio diversification. I mentioned it earlier, right? Is there ways to improve diversification through giving of assets? Is there ways to, not just investment diversification, but like asset vehicles, IRAs, taxable accounts, Roth IRAs? Are you diversified that way as well? And how can we, give strategically from those specific vehicles? So it's a long-term focus, and again, use your professional, lean on us. We have experience with this. We've been working on this, Mike, 20 plus years. I've been doing it for 18 years. Your advisor all across Savant, has a team of resources to help you make the best decisions here.
Yeah, and here's some helpful questions to ask yourself. So we want you to go into giving, being thoughtful. Growing up, what did your parents do? What did it look like in your family giving? Did it mean, donating at the local food station, or joining a board of directors? Maybe you're doing something now as part of your career. I know several people who serve on local nonprofit boards of directors and get a lot of benefit and personal equity by doing that. What sort of impact do you want to have in the world? How would you describe that? These are things to just kind of narrow the focus of how we could utilize your resources to give. And it's important for your advisor to know these things and really get to know you.
Yeah, thanks, Mike. Another way to look at it, like gifting now versus gifting later. A big part of this conversation, right? Great benefit of doing it today, not just, current year tax deductions, but you get to see how your giving helps your organization of choice, right? You can see how they implement it. You can maybe have a say in how they implement it, right? But there's gratification in that. That's a powerful feeling. So is the powerful feeling of saving on taxes, right? If you can save thousands of dollars in a potentially high tax year, right? There's merit to that. You can think about what might be left over for your heirs, right? To be completely honest, some people don't necessarily want to give their whole estate, all their assets to their children, right? Others do, but they want to give during their lifetime, right? So the timing questions, right? Certainly a personal choice, but questions, right? Conversations to be had to determine when is most advantageous, and not just financially, but personally, what's going to give you, the most gratitude and the most internal intrinsic benefit of your giving.
So why do we give? To this point, we're spending a lot of time talking about the reasons to give, educating yourself about, ways to give and why and how. One of the things personally, I'm on the board of directors and have been for maybe 10 years now, a nonprofit locally, cancer related. And I do so because I've had several people in my immediate family be affected by cancer or pass away as a result of cancer. And it gives me, a lot of benefit to just seeing my time and dollars go to help others who are going through similar circumstances. So that's why I give. You have to find your own reason. And once we know that reason of why you want to give, how you want to give, then your advisor can help you understand maybe the ways to do it that are going to benefit you. And Rob, if you advance to the next slide, please. So these are the things, that are why, your passions. Is it transactional? Is it transformational as far as, the amount we're talking about, generational beliefs? What we want to do today and starting right now is talk about how can we incorporate the last two, the investment strategies and tax benefits into your giving, because we might as well get a tax benefit if we're going to be spending the time, and it helps you be able to give more by doing so in a tax efficient manner.
Yeah, that's a really good point, Mike, the giving more. And I think the next example highlights that. Well, first, let's let's look at the vehicles, right? There's various vehicles to do this. There's charitable trusts, there's charitable annuities, donor advised funds, qualified charitable distributions, using your IRA to give, right? Donating long-term appreciated securities. So this is, going back to my previous statement here, a way to potentially actually give more, right? Than if you sell an asset that has a large embedded gain. So let's look at this scenario. Again, this is specific to taxable accounts, right? IRA is not included in this. So your joint accounts, your trusts, your individual accounts, vehicles where when you buy something, you establish a cost basis, and over time, those assets, you hope those investments grow, right? So you can donate these highly appreciated assets rather than cash, right? Rather than cutting a check for $50,000, $10,000, whatever it might be, like looking at your portfolio, finding an investment that has grown over the years and using that can give you more bang for your buck. So in this assumption, we're going to assume stock ABC is worth $50,000 today. You bought that for $5,000. Okay, so your cost basis, $5,000. There's an embedded gain of $45,000. If you sell that, you're going to pay the federal long-term capital gains rate of 15%. You're in the 24% tax bracket, right? So you've got, again, this appreciated stock, selling it, you've kind of pushed it away because, well, I don't want to recognize that gain, or it's just something that, like, paying the tax on it is too burdensome. Well, here's a solution. Rather than selling, let's look at option one. We'll start there, right? You sell it. You're thinking, I'm going to cut a check to my charity of choice. And to do that, well, I need some liquidity. We're going to look at ABC stock and sell it. Okay, so you sell it for $50,000. We know there's that gain you've incurred of $45,000. That's going to be taxable at 15%. So that tax cost to you is $6,750, right? In essence, you're now left with $43,250. You have that amount of liquidity, assuming you're holding that $6,750 back for taxes, left to cut your check. Okay, still a great amount to give. Now at your 24% tax rate, in your 24% tax bracket, that savings, that deduction you'll get is $10,380. Well, we know there's also that tax cost of $6,750, right? So it's a haircut. Your benefit is just $3,630 in this scenario. Still good, still better than nothing at all. But option two, work with your advisor. Let's transfer those appreciated shares in kind over to your charitable organization's account. They sell the stock, right? They can sell it under their tax efficient 501c3 umbrella and not recognize the gain, right? So now you are pushing the $50,000 of appreciated stock out of your portfolio. You get the full tax deduction on $50,000. $12,000, right? Well, that's a lot better than the $3,630, right? You're coming out ahead. You get an additional savings of $8,370 in this scenario. Powerful, right? So not only did you get more of a tax deduction, right? I think there's, again, this is coming from the wealth advisor perspective here. There's really good reason to do it. You've had this appreciated stock that's kind of been sitting in your portfolio, potentially, an overweight asset that can mess with your allocation. Well, this is a great way to not only get a tax benefit, but to improve your asset allocation, right? A double win, for lack of a better way to put it. So if you examine your taxable accounts, again, your trusts, your joint accounts, your individual accounts, if you have securities that you bought a long time ago or that you bought recently that has just done extremely well and you're hesitant to sell because you don't want to recognize the gain, well, think about donating that appreciated security to the charity of your choice. Great way to approach this. So I'm going to pass this off to Mike. It's kind of a similar idea using appreciated securities, but this takes it a little bit further, Mike.
Thank you. Yeah, so this is a way to really take it another step further and utilize something that you can work directly with your advisor to set up. I was going to piggyback off of what you said, Rob, and I've had I've known some folks who have utilized their own small business stock and donating that to charity if they have an upcoming sale of their business. So if you're thinking about selling a small business and have a charitable inclination, we could look at ways to maybe take a donation for part of your business stock before the sale happens. There's a little more red tape to go through, but I've seen it done, and it's an interesting way of donating. In that year of stock sale as well of your business, you're likely going to have higher income than you might have in other years, and so it might be a good year to examine that option. Using donor advised funds. So really piggybacking again off what Rob said, if you want to donate appreciated stock that you own within a taxable portfolio, you can set up what's called a donor advised fund with your advisor prior to the end of the year and simply move your appreciated stock into this donor advised fund. It becomes a fund that you still control the assets within that fund. You avoid paying the capital gains tax, as in Rob's example, so still the same benefit. But now instead of giving the money directly to charity, maybe you want to give a larger amount because you do have a large income year, right? Either sale of a business or a big bonus at work. So you've got some extra cash, and as a result, you may decide I'm going to donate some of my appreciated stock, but I don't want to give it all to the church or to my charity of choice, right away. I'd rather continue to dribble out money to them as I do on a monthly basis or on an annual basis. You could move some money into what's called this donor advised fund. The money could stay invested and continue to grow. And then in an example, you could donate $50,000 worth of stock and then dribble out maybe $5,000 a year for 10 years to the charity of your choice or multiple charities of your choice. It will continue to grow, hopefully, all while, spilling money out to your charities. You get the deduction, though, for the entire $50,000 in this example. So it can help in those years where you've got large income that we're trying to offset. It's just another arrow in your quiver, I guess, to be able to reduce some taxes or give tax efficiently. I will note that you probably want to get your donor advised fund set up in a relatively quick manner. It's November 5th today. So if this is something you're interested in, talk with your advisor within the next 3-4 weeks, I would say, certainly, to get that set up. On the next slide, we'll talk a little bit about why it's important to plan tax efficiently with your giving, right? So in this example, we are looking at 5 years worth of giving. And you can see that these different pieces represent the deductions that add up into your itemized deductions. Since 2017, a lot of folks have not had to provide as much information to their tax preparer because they simply did not have enough deductions to get over what's called the standard deduction. The standard deduction for 2025 is $31,500. So you need to have mortgage interest, property taxes, and state taxes, which have been historically capped at $10,000. Charity or medical expenses. All of those things have certain limits applied to them as well. but once you get through that entire calculation, all of them have to add up to more than 31,500 to really see any advantage of those expenses. So folks will oftentimes give to charity, and we don't do so for a tax deduction, right? But you may notice on your tax return that you gave $5,000 to a charity and you still didn't itemize, and so there really was not a tax benefit. So we want to talk about ways that maybe we can get that benefit. One of them being the donor advised fund or gifting appreciated stock. Rob, if you could show the next slide. Another way might be, how do we supersize our charitable contributions? So that might be utilizing that donor advised fund, or what we call bunching contributions. We could work with our favorite charity and say, okay, this year has been a good year for me. I want to give to you 50,000, just to stay with the example. However, I'm used to giving you $10,000 a year. Instead of that, I'm going to give you 50,000 now, and for the next 5 years, I'm not going to, or I'm just going to give minor amounts, and work with your charity to help them understand, if they're relying on your annual contribution, help them understand what you're doing and why you're doing it. In this example, in year one, we're getting a large contribution and a reduction in your taxes. And in the following years, we continue to use the standard deduction. Thanks, Rob.
Yeah, I think this is a great example, though, of really maximizing taxes, focusing on a year that income is high, right? How do you mitigate that? Well, you lump it together. Now you could do the same strategy in a donor advised fund. You lump it, the accumulation of the future 5 years, this year, right? And then, as Mike said earlier, you're in control of that. You can still give to your charity equally over the next 5 years, but because you put that into your own donor advised fund, you get to recognize a tax deduction this year, your high income year, fully understanding the next years you'll probably just go back down to the standard deduction. And that's okay, because income, for planning is going to be less. A super cool strategy. Again, Mike mentioned we are now in November. There are some time considerations to it. So if this is something that is ringing a bell for you, reach out immediately as soon as you can, so we can see if it's feasible yet this year. So I'll take the next one, and this one's really cool. This is a way to utilize your IRA, right? The previous methods focused on taxable accounts, appreciated securities in those accounts, donor advised funds. This is a way to use your pre-tax savings, all the years you contributed to your 401k, IRA. Well, those come out at your taxable income rates, right? And that can be fairly expensive in retirement, or when you do need to tap into those. We also know that with IRAs, right, there is something called the required minimum distribution. It used to be at age 70 and a half that a person had to start drawing against their IRA. The IRS wants their revenue. This is a way to force people to get it out of that tax advantaged account and get their revenue pause on it, so to speak, right? Now, the RMD age has moved to 73. I think that's important to note. That said, this next strategy, utilizing a qualified charitable distribution, you can still start that at age 70 and a half, right? So you've saved well over the years. Your IRA has grown to a point where you might not need it. You might not want to take all that income. Well, how can you avoid it? Well, you can take some of your RMD and send it directly to a charity, right? By doing so, it avoids income taxation. So you have an RMD of 100,000, so to speak. Just in as an example, you can give 50 of that away and take the other 50. You have an RMD of 30,000. Well, and you don't need that. Your cash flow is solid from other sources, right? You can give all of that away. up to $108,000 this year. Your qualified charitable distribution cannot be more than $108,000. But this is a tool that we have seen become more and more popular, over the years. Markets have done well, RMDs have grown, people are, doing great planning with us and, with Mike and his team, right? And how do we limit the taxation? Let's send it directly to the charity. How does that work? A lot of times we get instructions on your IRA. You tell us the recipient, we get their address, come November, come June, whatever the time is, you tell us when and how much you want to send it over to them. We cut a check, they have it, they cash it, right? It's out of your IRA, no taxes. There's a caveat here. You can see down at the bottom of this slide, the IRA custodians do not necessarily identify that a distribution from your IRA was a QCD, right? So if you had $100,000 of IRA distributions and you sent 50 of those to your charity of choice, your 1099-R is still going to read just like a taxable distribution of $100,000. You need to, or I need to, working alongside of you and working alongside of Mike, inform your tax preparer that 50 of that was a QCD, so they can take appropriate steps to assure you get credit for it and you are not taxed on that full amount. Very similar.
Yeah, Rob, I might just add in,
yeah.
I appreciate that because unless you tell us or unless we work directly with your advisor as your tax preparer, we're not going to know that you gave that money away. If you do it 1 year, we're probably going to be asking in the future, because we know that you got a history of that. But make sure to just be extra on top of it, letting your tax preparer know. The other thing I just wanted to really point out here is, this is a way of avoiding all the ways that the tax code limits your deductibility of charitable contributions. This RMD distribution directly to charity comes right off the top of your taxable income, and you save taxes on 100% of the amount that you send to charity. So it's a great way to do it. And if you're coming up on that age where you're going to have the requirement on distributions, talk to your advisor about it and see if it's right for you. Thanks, Rob.
No, thank you, Mike. And I was going to say that this is, again, we are in November. This can take some time to get set up on your IRA, to have it in place. So there is some time considerations here to think about. So reach out to your advisor, reach out to Mike, your tax preparer, to your financial advisor, and walk through it with them. See what they say, and if it's something that makes a lot of sense, right? If your retirement plan can sustain it, your cash flow is good, a fantastic way, like Mike said, to get a dollar for dollar. Reduce your income dollar for dollar, I should say. Next vehicle, a very neat one, a charitable lead annuity trust, CLAT for short. Maybe a less common strategy. Yeah, perhaps haven't heard it as much as a donor advised fund, a QCD, or just writing a check, right? But with the CLAT, the charity receives payments during your life, or the lives of you and your spouse, for a specified term of years. Typically about 10 to 20 years is what we see, right? This is valuable in the right situation if you have larger principal amounts, perhaps, that you're looking to get out of your estate and to get a larger deduction in a given year. This would be something to explore. So as the term annuity in the CLAT, right, charitable lead annuity trust, suggests, there is a fixed payment, right? You give, in this example, $500,000 into your CLAT, your charitable lead annuity trust. $500,000 out. As we're drawing up that document, there's going to be a fixed payment, say 5% each year for 10 years, for 20 years. That goes directly to the charity. So $25,000 in this example each year for that specified term. Really beneficial for you and the larger deduction you get. But if you think about it from your charitable organization's end, like they know now that they're getting this specific payment each year, they can budget for that. Very beneficial for them, right? Really cool tool. Now, the value of the transfer is reduced by the value of the payment stream. So if you put $500,000 in, there's going to be a formula that actually calculates the present value of that annuity, and that's what you get deducted. It's still going to be a healthy amount. And it channels the future appreciation to the trust beneficiaries, estate tax free. Again, so estate planning, large amounts of principal available, high income year. Maybe we consider a CLAT as a way to explore, reduce your taxes in that year, but really support your charity in a meaningful way. So again, we're advisors, we see this every day, right? So I hope our explanations of those vehicles did it justice, did you justice? If you don't, again, questions in the Q&A. But let's review, right? Bunching donations, right? Taking funds this year, well, looking out maybe 5 years, and instead of doing those spread out over those 5 years, bunching it then this year so you can get that itemized deduction. Powerful tool. Doing that within a donor advised fund. Again, you maintain control of that fund. You still have discretion on when and who gets those funds, but you've received that tax benefit in a given year, likely a year where your income could use some deductions. We talked about qualified charitable distributions, right? Utilizing your IRAs. Sometimes the IRAs are a forgotten vehicle when it comes to charitable giving. And often, like in some circumstances, they can be the most powerful, right? You can get a lot of income tax, wiped off the slate if you do it the correct way. All right, so work with your advisor, ask us how we can help with that. Charitable trusts, right? We just examined the CLAT and how giving larger amounts of principal into a trust, which then kick off a known quantity each year to your charity of choice. Super beneficial to you, super beneficial to your organization of choice. They know how much is coming. They can budget for that. Really cool tool if that works for you. And really this flows into estate planning, right? These are all ways to think about how to reduce potential estate tax liability, who your recipients are going to be, beneficiary wise, and leaving it to children. You can also leave it to charities. So giving does not have to end while you're living, so to speak, right? There's a lot that you can do once you're gone within your estate plan. So I'll turn it over to Mike to touch base on the estate side of things in a little bit more detail.
Thanks, Rob. Yeah, so with estate planning, you just want to make sure your documents are reviewed, every few years to make sure it reflects, your current thinking with regard to how you want your assets to pass, as well as current laws. Those always seem to be changing or increasing, exemptions, et cetera, which we'll talk about a little bit. In addition to that, you can incorporate charitable giving into your estate plan either relatively easily via simply naming a charity as as a beneficiary of your estate. That might be helpful in the event that you got a taxable estate and you want to reduce the amount that's going to pass to heirs down to the estate tax exemption. You can give the rest away to charity. We should all be so lucky to have that problem, right? But if we don't have a taxable estate, then it's just a matter of, do we want to, bequeath some of our assets we've built up over our lifetime to a charity that's meant something to us during our life. So you can work with your advisor and your estate attorney to incorporate giving very easily within an estate plan. You could also utilize some of these charitable trusts and things that Rob previously mentioned. If you wanted to get a little bit more into the weeds on those things, there's all sorts of options you can utilize. The next slide, we're going to talk a little bit about some things that have been up in the air recently, right? So prior to the passage of the big, beautiful bill on July 4th of this last year, there were all these questions that were coming up because at the end of 2025, the prior tax law was expiring. And so many things were going back to 2017 rates, meaning some of the brackets were getting smaller at the lower half of the brackets, and people were going to end up paying more taxes. The standard deduction was going to be reduced again. There were questions about capital gains rates and what's going to happen there, as well as eliminating cost basis step up upon your passing. So I'll touch base briefly on each of these. Higher rates and cap deductions. So I mentioned the marginal tax rates and brackets were going to be compressed at the lower level, meaning some folks, 250,000 and less, married filing joint, we're going to have income taxes increase. The most recent tax bill kept those the same and made them permanent. In addition to that, you may have noticed, or we talked about earlier, that a lot of folks don't itemize anymore. And one of the reasons for that is if you live in a high income taxed state, where you're paying a high amount of income taxes to that state, the benefit, or excuse me, the deduction on your itemized Schedule A was limited to $10,000. So you add up your real estate taxes, your taxes you pay on your vehicles, and then your state taxes, and those might be $20,000 altogether. Historically, you used to be able to deduct $20,000 and add that towards your itemized deduction, but that was capped at $10,000. With this most recent bill that on July 4th, they've increased that cap to $40,000. So now folks who live in a higher income tax state may be itemizing. We'll have to see how it all plays out this year. But that's something that we now have a little more clarity on. Also, there was all sorts of talk about a decreased estate exemption. The expectation was that the new law, in order to increase revenue for the government, we might be reducing our estate exemption to $7 million per person. So we'd still have $14 million excluded before you're taxed on your estate after you pass away. Well, that was also changed as a result of the big, beautiful bill. And instead, in 2025, we're still at 13.99 million each that you get to exclude before you're taxed. In 2026, it goes to 15 million, and then it's adjusted for inflation thereafter. So unless you've got 30 million or more in total assets upon your passing as a married couple, once you both pass away, that's when that potential tax would come into play. If you don't have more than that, then we don't have to worry about the estate tax. If you do, or if you're getting close, or if you're young and you've got a certain dollar amount, we will help you analyze that and decide if there's some things we should do now to maybe get some assets out of your estate to make sure you're under the exemption.
Hey, Mike, and to add to that point, I think it was set to revert back to about 7 million, right? From
that was the
13.99.
Yeah.
So you can see, like, had it not been extended, like all of a sudden, a lot more people are impacted by that, right? So getting assets out of your estate at that point, becomes a lot more relevant to people. I mean, it's a large sum of money, but it's with years of investing and savings, right? It's not that far away for many people.
That's right. And we're in Iowa, which has a large constituency of farmers. And a lot of those folks have, could have affected those or a lot more people in that situation. Capital gains rates. There's always talk about capital gains rates going up. The highest individual income tax bracket is 37%. The highest capital gains bracket with the net investment income tax ends up being 23.8%. So quite a benefit to realizing income via capital gains versus ordinary income. The expectation was that, or not necessarily expectation, but it's always a concern that those rates are going to be taxed as ordinary on long-term capital gains as opposed to the benefited smaller bracket amounts. But again, 23.8% going forward is what we can expect. And then the other talk was that they were going to eliminate cost basis step up upon your passing. So if you don't know what that is, when someone passes away, they get to step up their cost basis in that asset. So you own a share of stock and you bought it for $50 and it's worth $1,000. You die owning that stock under current law, the cost basis steps up to $1,000 for the value at date of death. And then your heirs could sell that share of stock and realize no taxable income. So it's a big benefit to heirs and to estate planning. And that also did not change. So for now, we're good. Many of the things in this BBB bill state that they're permanent. We all know that that's only as permanent as the next administration that comes in. But these are things that we can at least rely on for the time being. And it's good to have that with 6 months left, in the year for planning and things. So if you have questions on any of that, please put those in the chats and we'll be happy to talk with you about how that might affect you going forward.
Thanks, Mike. That was good stuff. Yeah, so we've covered a lot, right? Big picture questions as you're going into creating your philanthropic plan. We've reviewed the vehicles available to you, some of the vehicles available to you, the primary ones that can help reduce taxes, get you to where you want to be. But really, how do you formalize it, right? We've done it, and it starts with sitting down with your advisor, reviewing and identifying the assets that might give you the most benefit, right? Those appreciated securities, those assets in your IRA where we can utilize a QCD to get those out, right? Then we need to talk about the timing. Do you want to see the benefit while you're living? Or is this a testamentary gift, right? Upon your death, you need to maybe assure that your heirs, your spouse, your significant other is taken care of during your lifetime. And while you want to give, well, that's a secondary goal to assuring assets are available, capital is available for those remaining family members. Well, you can give upon deaths, right? You can do it testamentary, right? Leave assets to charities. And we see that all the time, right? You see it on the news. We see it in our, folks we know, their beneficiaries, their designations. Determine, do you want your kids involved? Do you want them to understand what might be coming their way? Do you want them involved in potentially a family foundation to where they can direct some of the family's wealth? Again, not every parent wants or trusts their child coming into a lot of money. Maybe it impacts their career path. They want them to stay engaged. Others want their family to receive it all, right? But engage your family if that's something that you think would be beneficial. It could be good for the second generations to see how giving works and the intrinsic benefit of the giving. And you determine the dollar amounts, right? We integrate it with the tax side of things, with your tax advisor like Mike, seeing how QCD impacts things versus itemizing deductions using a donor advised fund. We're going to document it. We're going to implement it into your overall financial plan, right? And maybe that flows into a more detailed estate plan. And you take all these big picture questions, look at your specific investments, your accounts, right? The accounts that you have at your disposal, taxable, pre-tax, all of that to really formulate your ideal plan. We'll see if it works, and we'll help you put it into effect.
Thanks, Rob.
If you want to review in greater detail, oh, sorry, Mike, I cut you off.
No, that's okay. I was just going to say the same thing. We're going to take some time to answer a few of the questions we see in the chat here and make sure we've covered all the bases here, but we won't have time to answer everything. If you look to the chat, you can see a link in there where you can schedule a free 15-minute phone call with us. We can go over questions you have and set up maybe an in-person meeting at some point or Zoom. Be happy to talk to you about anything that we may have covered or anything else that you want to discuss. Shall we get into the questions, Rob?
Yeah, so there is a disclosure slide that we want to show, but next let's look at some questions here. Mike, I did see one with regard to charitable contributions. Did the Big Beautiful Bill introduce some new rules starting next year in 2026?
Yes, good question. There were a few things that are going to change. So in 2026, we are going to have a floor on contributions prior to being able to take a deduction for them on your itemized deduction Schedule A. Simply said, what that means is it's 0.5% of your adjusted gross income will be excluded. So as an example, let's say you've got $200,000 of adjusted gross income. That means your W-2, your investment income, Social Security, whatever that might be, that adds up to that line on your tax return. 0.5% of that, or $1,000, is excluded before you're going to get a tax deduction or be able to add that to your Schedule A. In addition to that, in 2026, there is an above the line deduction for married couples of $2,000 and single filers of $1,000. What an above the line deduction is, it simply means you can give $2,000 to charity and get a tax deduction for it, whether you itemize or not. So that's something that'll go into effect next year and help out for at least a little bit on some of your charitable contributions. Let's see if there's one for you, Rob. Let's see here. QCD question. It's getting close to the end of the year. If I haven't taken my QCD, can I still do a charitable donation?
Yeah.
My RMD, excuse me, it's the RMD, right? That's what it is.
Oh, yeah, that makes sense.
Yeah.
Yeah, you still can. There is still time. We touched on this a little bit during our conversation, right? Anytime we get to November, December, mail starts to slow down. Things do start to get a little compressed as it comes to the deadlines. So if it is something you want to explore and potentially use, yes, I think you can still get it done at this point in the year, but it would be something to attack and get on your agenda right away, right? Ultimately, like if you send a check from your IRA to that charity, we have to assure that that charity cashes the check in 2025 for it to be valid. So time is getting to be the essence. Same with the donor advised fund, right? It does take work to establish the donor advised funds. It's not as simple as logging on, clicking a few boxes and having it ready to go, right? There is a process to it, and it can take a couple of weeks at least to get it in place. So if you do wish to take advantage of some of the vehicles that we discussed, right, that are time sensitive, we recommend putting that at the top of your list of things to do, reaching out, seeing how we can help. But we welcome that opportunity. Again, that's what we're here for. It's really what we enjoy doing, right? We're professionals in this business that, you know, have seen a lot, helped people get to their retirement goals, and that's certainly fulfilling. But, you know, a lot of times after these, we work closely with the recipient. So once that donation hits, you know, we get thank yous too, and it's really cool, right? Again, we didn't make the donation, we just helped facilitate it, but that's pretty fulfilling to us as well. So
absolutely. Rob, I was going to show, there was another question here. I think we have time for one more, and I can take it, but are the tax benefits the same when you give to a donor advised fund as when you give to a charity? Yes, you get the deduction, whether you're giving cash to a donor advised fund or appreciated stock, or you give it directly to charity. You get the deduction on your tax return. You'll want to work with your tax advisor, though, an investment advisor, to make sure that it fits into your overall tax picture, right? Because, you know, a $2,000 donation to a donor advised fund, if it's cash, may not help you to itemize, and it's not getting any appreciated stock out of your portfolio. So you really want to make sure you're doing it in a meaningful and thought out way in order to ensure that you get a tax deduction.
Exactly. Mike, thank you very much for your expertise today. Really appreciate it. I think we'll wrap it up at this point. Thank you everyone for your questions. If we didn't get to it, and please feel free to reach out. We'll happily address those, you know, more individually. If you are looking for more information on Savant, you know, we invite you to go to our website, savantwealth.com. But thank you for an hour of your time today. Hopefully you took something away from it that's valuable or gave you some ideas. And, you know, we look forward to any opportunity you might give us to help you, you know, get to your philanthropic goals or your retirement goals or your tax planning goals. But again, thank you so much.
Thanks, Rob.
Appreciate your time.
Thank you, guys.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.